Welcome to my mortgage channel. Hello, this is J. Mike Perkins, and I'm here to answer that burning question that you've probably been afraid to ask. What are qualified and non-qualified mortgages? You know, the government has a bad habit of making things more difficult than they should be. For example, there are 8 different federal agencies that all regulate the mortgage business. And one of these agencies, the Consumer Finance Protection Bureau, came up with a good idea. They were going to help consumers understand mortgages, which can be very complicated, by taking them and putting them into 2 different categories. One category would be what they considered to be lower cost, lower risk mortgages. And the other category would be what they considered to be higher cost, higher risk mortgages. But instead of just giving these easy to understand names, maybe low cost, high cost, low risk, high risk, no, they come up with very confusing terms for them. They call them qualified and non-qualified mortgage. Now, although these terms mean absolutely nothing to the average person, they're actually quite important both to you as the consumer and to the lender because these 2 types of loans are handled differently. Now, there are many characteristics to qualified and non-qualified mortgages, and I can't claim to cover all of them, but I'll give you the main ideas. Qualified mortgages have 3 main characteristics. The interest rate has to be within a certain limit as set by the Consumer Finance Protection Bureau for that type of loan and that loan amount. A qualified mortgage has to respect a limit on lender fees. We're talking about things like origination charges, points, broker fees, not third-party fees. And then finally, a qualified mortgage cannot contain any of what the Consumer Finance Protection Bureau considers to be risky loan features. It can't have a term more than 30 years. It can't be a type of mortgage known as interest only, where if you only make the minimum payment, the loan is never actually paid off. It can't be what's known as negative amortization, where the minimum payment due doesn't even cover the interest for that month, so the balance on the loan keeps going up. And finally, it can't be what's known as a balloon mortgage. A balloon mortgage is amortized over a longer period, say 30 years, but is due in full at a much sooner date, say 5 years. So what is a non-qualified mortgage? Well, in simple terms, it's anything that is not a qualified mortgage. Now, there are lots of examples of different loan programs which are non-qualified mortgages. I'm just going to give you an example of some of the more popular ones. They include a whole family of loans where the income being used to qualify for the mortgage is different than on a normal qualified mortgage. For example, loans to real estate investors where the property rental income is being used to qualify for the mortgage. Loans to self-employed borrowers where a percentage of the bank deposits are being used to qualify. And loans to borrowers with significant assets where the value of the assets is what's being used to qualify. Other examples include mortgages to borrowers with credit issues, mortgages to borrowers with higher than normal debt-to-income ratios, mortgages for borrowers that might have employment issues, mortgages that contain non-standard features like terms of more than 30 years, mortgages for foreign nationals or those without Social Security numbers. I don't think non-qualified mortgages are bad as long as the borrower doesn't qualify for a qualified mortgage and as long as the borrower understands the terms and costs of the loan. Thank you very much for watching. This is J. Mike Perkins. If you would be so kind, would you mind hitting like and subscribe?